Hi everyone, and welcome back to the Swing Trading Beginners course. This is video 8, one of our favorite reversal patterns, the double bottom pattern. In our prior video, we talked about the rounding bottom, which is more of a favorite of ours. It's actually a better pattern, we believe, and we've had more success with that. So you want to check out that video 7 about the rounding bottom pattern. But this one is very popular among most traders, and it's considered a reversal pattern and bottoming pattern, but it's also a very good consolidation pattern with a stronger long-term uptrend. Okay, so I'm going to show you an example of that in this video, not only with stocks, but also with a major index. And again, I'm Brian Neal, founder of Tradetobefree.com and InvestBeFree.com, and I've been using these techniques for the last 12 years in my own trading. We're part of the Better Business Bureau, and we have an A+ rating with them, and you can check out our rating on their site. Okay, the double bottom pattern. You've heard about this, I'm sure. A lot of traders play this, especially on shorter time frames, which I believe it works a little bit better actually for short-term swing traders and also day traders even, sometimes more on the longer term than the longer term time frames, although the gains on the day trading patterns are much less, of course. So, but it still does work if conditions are right and you get a really strong breakout, and that's what you want to look for with this pattern when swing trading. We had a video that we published over the summer on the double bottom pattern. That was the first video we published on this chart pattern, and we did it on the S&P 500 as it was breaking out of a double bottom pattern. You know, that I believe was in July of 2016. In the video, we said that the S&P 500 was in a strong long-term uptrend. It was forming this double bottom pattern. It's also considered a consolidation pattern within a long-term uptrend, and that the S&P 500 was likely to move higher. It wasn't a really strong breakout, but we could see, or should see, a continuation of the uptrend going forward, and that's what we've seen since then. Not a real strong move. I think we saw a 10% move higher from that point within several months. So yeah, it's not only a reversal pattern and bottoming pattern, but it's also a consolidation pattern. You can find these on the major indices and also individual stocks and ETFs. Like I said, it's really good to know too for shorter term swing traders as well as longer term swing traders. We like to find it on weekly charts, which tells you a lot about the long-term trend of a stock. And I want to get back into trend analysis basics because as a beginning swing trader, or one that's been swing trading for a while, it's very important to understand the different trends that go on with a stock or index, on these different time frames. And the long-term trend, when I refer to that, that generally means a trend that's been going on for at least several months to many years. In the case of the S&P 500, it was in a strong long-term uptrend for a number of years. Okay, an intermediate term trend is a trend over the past several weeks to a few months, but can be longer. Okay, and the short-term trend is a trend over the past few days to a few weeks. Not only do you have those three trends generally for a stock or an index, you also have shorter-term time frames intraday and over the past few days that are also interesting to understand and can help you a little bit swing trading and are especially important for day traders. Okay, one of the reasons why we look at trend analysis is to understand where the trend is now and also when the trend is likely to change. This is critical. One of the typical things that you'll see as a long-term trend breaks is you'll see during the long-term uptrend certain moving averages, or in some cases you can draw a line connecting the lows in the trend, and it will touch that support level 3 or more times. If it touches 3 or more times, it's a confirmed support. If it touches it twice, it's not confirmed and can almost be ignored. There's also support and resistance, which is also important. But when you're talking about a sloping trend, either up or down, if you don't have at least 3 touches of that trend, it's really not as important in your trading. Okay, so I want to point that out. Delivering this course, when you see a long-term uptrend break, which is what we're very interested in, if we're trading to the long side within that long-term uptrend, the typical behavior is to break that uptrend support, okay, move below it, rally back to the former uptrend support. That might be the moving average. It might be a line connecting the lows in the long-term trend. And then you'll see that the stock turn over make a lower high, and then confirm the new trend to the downside by going below the prior low that occurred shortly after the stock went below the uptrend support. Okay, I'm going to show you an example of this to better illustrate it. Okay, so without that consistent uptrend support, what we look for is a lower high on a time frame matching the prior wave's higher. So it took 3-4 weeks for each rally to unfold in the past, and we see another rally over that time frame that stops well short of the prior high in the prior rally. Okay, that's the first signal that the trend is changing to the downside. We want to see a strong move off that lower high, and we want to see the trend confirmed to the downside with a lower low if we're going short, and also finding resistance at key moving averages. All right, but I just wanted to point out trend changes, okay, so you can be aware of them, whether you're going long, playing an uptrend, or playing a downtrend. The exact reverse is true in a long-term downtrend or an intermediate-term downtrend, which we often see during a long-term uptrend, okay, where you have a higher low followed by a higher high, and that's a confirmation that the trend is switching back to the upside. All right, and it's also very key. All right, now this is very fundamental to technical analysis. Okay, I don't care if you trade bearish head and shoulders patterns, bull flags, rounding bottoms, etc. With the bearish head and shoulders pattern, for instance, what that is on the right side of the base, you've got a lower high followed by a lower low. That's sometimes called a 1, 2, 3 trend change. And that lower high followed by the lower low is key to indicating the trend is about to go, or the price is about to go lower. Okay, that rally is fading, and we're about to go into a new downtrend consolidation phase for the stock or the index. Okay, back to the double bottom pattern now. Okay, so I'm going to show you an example from a recent trading set we had in our newsletter to show you the differences between these different time frames. Now, you can see that on this chart of MKTX over the past year or two that we have these waves, these rallies, and these pullbacks over time, and there's actually different trends going on in multiple time frames. All right, so if we look at the last year and a half, we can see overall we're making higher highs and higher lows, and we're tending to hold above the 200-day moving average. Now we went a little below here, but we gained the 200-day moving average and moved higher. Okay, so that is an uptrend support. If we can find 3 lows matching up, for instance here, we can see that we have an uptrend support. Okay, that's broken at this point. And up here, if we draw this line. Now within this long-term uptrend, we also have short-term uptrends, short-term downtrends, and intermediate-term uptrends and downtrends. Okay, so for instance here we can see that we have this short-term downtrend, okay, coming back to near the uptrend support, which you could say with this stock is around the 200-day moving average. Okay, so that's a short-term downtrend. Then we have a short-term uptrend and making a lower high, and then we see the short-term downtrend here, a short-term uptrend, a short-term downtrend, a short-term uptrend, and so forth. And we can see on this longer-term time frame, we're actually making lower highs. So this is an intermediate-term downtrend, okay, within a longer-term uptrend leading into the pattern. Okay, so a very interesting entry point would be a breaking of this intermediate-term downtrend, okay, back to the upside, if we're playing this long-term uptrend to the upside. But I just want to point out and review the short-term, intermediate-term, and long-term uptrends that we defined earlier in this course. Okay, now getting back to the double bottom pattern. The double bottom pattern is basically a W on a chart. Okay, it's 2 successive lows, as the name suggests, on a chart. We like to find these on a weekly chart, on a longer time frame. The longer time frame, the better. On a daily chart, it works pretty well as well. Unlike the rounding bottom pattern, the rebounds are sudden and sharp, okay? And we can see that on this chart here, in this example of MKTX, which we featured as it was breaking out of this double bottom pattern. But you can see that there's 2 successive lows here. You can see that better on a weekly chart. If I bring up a weekly chart, it becomes a lot more clear. We can see this this first low followed by the second low. Now, interestingly enough, it's actually more constructive on a weekly chart if we see that prior low take out, or the second low take out the prior low, but just a little bit. We don't want the prior low to be taken out by more than a few percent. But if it goes a little below there, okay, that shakes out some weak long hands. You know, if we see a strong rebound from there, and if we see a move above the center point, which is this point right here, okay, this is a W again. All right, if we see the move above the center point of the W on very strong volume, that's the entry point on the double bottom pattern. Okay, so it's interesting about this when you look at the trends in the stock is that, yeah, it's a reversal pattern, okay, but in this case, it's a reversal pattern on an intermediate time frame within a strong long-term uptrend, okay, and that's what we want to look for, that breaking of that intermediate term downtrend within a strong long-term uptrend going back, you know, at least a year or two. Again, that move above the center point on very strong volume is what we want to see. As we can see down here on the chart, back at the point when it was featured, we had a very strong move above the center point, okay, with probably 2 to 3 times the normal average daily volume, and that's a really good sign. Okay, we want to see at least 50% more volume on the breakout, ideally more like double, triple, quadruple volume on the breakout. And if we're watching the stock during the day, we can see that the stock reached that point. See how it's doing that, look for a good day trading pattern near that entry point and get in at that point. If we're not around during the day, we can wait to see if it closes above this center point on the very strong volume. Okay, but if you're day trading, you'll be able to see the increase in volume as it's going above that center point. If you're not day trading, or if you're not looking at the stock during the day, then what you can do is just put in a buy stop order above the prior day's high the next day, and then that would be your entry point. Okay, again, we want to see very strong volume on that breakout, preferably much more than 50% increase on the average volume. When it does break out, that center point of the W will act not only as resistance, but also support. So if it does pull back, we want to see the price only pull back a few percent below that point before acting as strong support and then a strong move back higher. Okay, so if it goes too much below that center point, we want to get out of the trade. Okay, so once we're in the trade, where do we get out? All right, well, one thing you want to do when you swing trade is you want to phase out of the stock. So take a little bit off the table once you're up, say 4 to 10%. Okay, a little more if it gets off to a weak start, a little bit less if it gets off to a strong start. Okay, and then you can stop the remainder a little below the ideal technical entry point. Sometimes you'll get that pullback after the breakout, and you want to see that center point again act as strong support. So you can drop a stop loss, you know, say 3% below that center point around there. You know, pick a horizontal support around that point and drop it a little bit below there, 5 cents below there, let's say 10 cents. And then with strong growth stocks with very, very rapidly improving fundamentals, they tend to go about 15 to 25% higher from that breakout point over the next few weeks or so. Okay, so what we can do is just take some off once it gets above that 15% threshold and gets either near a round number, say $200 in this case, or 190 or 195 or 210 if you don't have a prior resistance level. Now, getting back to this example, if you go back a few years ago, okay, again, you can see the very strong long-term uptrend, which is a very good sign. In some cases, you'll see a stock that actually pulled back from a higher level prior to the entry point, or prior to forming the pattern, you know, 2 years ago, 3 years ago, and you'll see horizontal resistance levels up here. You can pick a point 15 to 25% above the entry point that are close to those resistance levels, okay, and pick a point just below a prior resistance. In this case, you know, MKTX is making all-time highs. It looks like all-time highs. I haven't gone back 15 years or more yet, but that may be all-time highs. Let's see if we go back further. Yes, we can see that we're making all-time highs. So it's a very good long-term uptrend on the stock, and that's what we want to see prior to entering the trade or even putting it on our watch list. Okay, so that's a good exit point for a good portion of your shares. All right, you may want to take all of it off at that point. Now, if you got a really good long-term uptrend support, okay, or a key moving average that's acting as strong support, what you can do is keep a small portion as long as it holds above that support level. And again, what we like to do oftentimes is wait for a close below that key support level and see if it goes below that support level the next day, and put a stop just prior to or just below the low made on the day it closed below the support level. Okay, so that's a good place to stop the remainder of your position. And that might be the 20 EMA again, that might be the 50 or the 200 or a uptrend support connecting the lows. So in this case with MKATX, if we go back and to our longer term chart, if we go back 6 years, we can see here that we've got the strong uptrend for the past few years. So we could connect these lows in the trend, okay, which about matches I believe that's a 50-week moving average. Okay, so that's a 250-day moving average, essentially. You could use that as the uptrend support to sell the rest of your shares, but you don't want to have it go below the entry point, even though we've got most of our position off at near this high. Okay, we want to not keep the remaining shares much below the entry point when we swing trade. Okay, so that would be, as time goes on, if this continues to trend higher, this support level will start moving beyond the entry point. Okay, and when it does that, then we can use that as our exit point for the remainder of our shares, and that trend could continue for a number of years, depending on the fundamental case that you're looking at, the overall market, and other factors. Okay, but you can keep a small portion of your shares, let's say up to 40% or so, until that long-term support level is broken. Okay, that's the double bottom pattern, and another really good pattern to have in your arsenal. Again, as we stated in the early going in this trading course, it's all about finding initially a couple patterns that you can start to learn and master on a simulator. And once you become really good at it, identifying it, understanding it, and trading it on paper without real money, you can then go and move to a live trading account, starting small, and then scale up as you get better and better. And that's the whole key to being successful in swing trading. And again, on our site, we have a newsletter that basically uses these strategies in real time. And for 3 weeks, you can get that with no credit card required, and you can start learning more there and find some great trading setups that we're watching in our own trading for a breakout or a entry point in the days or weeks ahead. In some cases, they've already reached their entry point. In other cases, they're setting up and getting close to a really good technical entry point. And again, we only focus on stocks that have really strong, consistent earnings and sales growth, and companies beating expectations with rising future expectations. Okay, so that makes us different, and that gives you a slight edge over not caring about fundamentals at all in your trading. So you can get over there and sign up for that free 3-week trial. Like the video down below if you want to see more of these, and leave a comment. And we also have a book and also some great video training on the site to give you some really great trading strategies and our favorites that we use in our own trading. So you can get that also on our site. We also offer a free blog that we update from time to time. Okay, well, that's it for now. The next video is going to be about support and resistance. If you have any specific questions too on this or any other pattern that we talk about in our videos, you can go ahead and shoot me an email at info@tradetobefree.com, and I can answer those for you. But the site has some really good information on these various patterns, and it's a great place to start along with the newsletter. So, okay, that's it, and I will see you in the next video.